We do have some news here today. While President Trump's new reciprocal tariffs took effect, he announced that he would nominate the White House's top economist, Stephen Miran, on a short-term seat for the Federal Reserve Board of Governors. This replaces Colger, so this has nothing to do with Jerome Powell. But this is another Trump appointee to the Federal Reserve Board. I think we all know that this is going to arc more towards rate cuts. They're coming. Really, the question is when. We kind of think September. The odds say September. This move here solidifies that rate cuts are definitely coming. Furthermore, Trump signed 2 executive orders on Thursday advancing the role of digital assets in the U.S. financial system. One order allows for 401k retirement plans to include cryptocurrencies, while others target the administration's calls for discriminatory banking practices against crypto firms. I love what they're doing for the banks here. Really need to start holding them accountable for some of the mistakes that they're making, whether it's crypto or political favoritism. The other one here about the 401ks to allow cryptocurrencies, I want to say on the surface that that's really good. I felt the same way about private equity, but Tim brought up some really good points. The really good private equity deals are probably not what you're going to find in the 401k. So while I'm cautiously optimistic about this, I'm gonna reserve the right to change my opinion to see what happens here. I think this is going to be good. I would actually like to allocate a little bit of crypto in my 401k, especially if we continue to see gains. I wouldn't overdo it, but I would definitely want to make it a small percentage of that just to see if we can juice some of those gains in a non-taxable environment. So we'll see. We'll see how it shakes out. I do think that this is progress and this is moving forward. Hopefully it doesn't cause a big problem down the road, but we'll see. 10-year Treasury bond yielded 4.2 and the 2-year bond was 3.74. If we scroll down to some analysis here, the chief equity strategist at Bloomberg Intelligence, Gina Martin Adams, shared a chart that shows the S&P 500 stocks that were missing earnings per share estimates have underperformed by an average of 6% in 2025. This is good because we often have been talking about what guidance does for these stocks that are reporting earnings. Nice to see some correlations drawn here with EPS estimates, and it looks like, boy, if you miss that, you are going to underperform. And the average there is 6%. This is a sharp increase from the historical average of 2 to 4% since 2017, including heightened market sensitivity to earnings misses amid a second quarter 2025 beat rate of over 80%, as per Charles Schwab data. Again, we've talked quite a bit about the bar being lowered. One of you had a killer joke here about the bar being so low, it's under the ground and very hard to trip over. And so 80% of the companies beating, that makes sense, but this looks like a second order type of analysis on EPS earnings misses. I think this is pretty valuable stuff. So shout out to Gina here. In addition to a higher consensus beat rate during the second quarter, accompanied by steeper declines on missing earnings, Charles Schwab research notes penned by Liz Ann Saunders and Kevin Gordon stated that the earnings bar is fairly low for the second quarter, setting companies up for a potential easy jump, but there will likely be more of a focus on guidance. This is confirmed by what we've been seeing when we look over all of the different earnings reports. The companies that guide poorly either guide down, withhold guidance, or anything like that. They get punished, sometimes punished double digits to the downside. Ultimately, earnings will be the lens through which we can judge its resilience in the face of tariffs, higher rates, and a slowing labor market. So far, so good, but we think the bulk of the market's focus will be on forward guidance as opposed to backward-looking results. Talking about the appointment of Miran as the Fed governor, Ed Yardeni of Yardeni Research said that it raises the possibility of at least 3 dissenters on the FOMC in the committee's if the committee, decides against a rate cut in September. Quote, these dissenters would likely argue that a weakening labor market justifies the rate cut. And on the other hand, if the Fed does cut the federal funds rate, a new group of dissenters could emerge, objecting that rate cuts risk reigniting inflation. According to Yardeni, the central debate is whether the recent weakness in the employment report stems from a weakening demand for labor or a shortage of workers. Quote, it could very well be both simultaneously, end quote. He explained the demand side argument. The TTT, Trump's tariff turmoil since April, may have caused many employees to postpone their hiring plans until the impact of their businesses became clearer. With less uncertainty now, hiring should resume. And in this scenario, if the Fed should hold off on cutting the FFR, the federal funds rate, and the dissenters will disagree. So I like this. Yardeni's kind of looking ahead here and giving you a scenario for both possibilities. And I think that's prudent for us to follow along with. Yardeni's personal view is that the problem is primarily on the supply side of the labor market. The labor force has stopped growing this year due to the Trump administration's effective border closures and ongoing deportations, he said. In this case, the Fed should also refrain from cutting the federal funds rate, as doing so would boost the demand for workers, worsening the labor shortage and putting upward pressure on wage and price inflation. A couple of things to consider there.